Today, we will talk about the process that companies use to compare their current performance with their desired, expected performance. A gap analysis is the process that companies use to compare their current performance with their desired, expected performance. This analysis is used to determine whether a company is meeting expectations and using its resources effectively. It involves recognizing the current state, comparing it with the target state, and creating an action plan to move the organization forward and fill in the performance gaps. When organizations aren't making the best use of their resources, capital, and technology, they may not be able to reach their full potential. This is where a gap analysis can help. It allows companies to determine where they are today and where they want to be in the future, and re-examine their goals to figure out whether they are on the right track to accomplishing them. A gap analysis starts by focusing on where your organization is currently operating at. Identifying the current position, determining the desired future state, bridging the gaps, evaluating solutions, implementing change, and monitoring changes are the steps involved in conducting a gap analysis. Market gap analysis entails making considerations about the market and how customer needs may be going unmet. If a company is able to identify areas where product supply is not meeting consumer demand, then the company can take measures to personally fill that market gap. Strategic gap analysis is a more formal internal review of how a company is performing. It entails comparing how a company has done against long-term benchmarks and may also be used to compare how a company is faring against its competitors. Here are 5 key takeaways. 1. Through gap analysis, an organization examines its current performance versus its target performance. 2. A gap analysis can be useful when companies aren't using their resources, capital, or technology to their full potential. 3. By defining the gap, a firm's management team can create a plan of action to move the organization forward and fill in the performance gaps. 4. There are 4 steps to a gap analysis: defining organizational goals, benchmarking the current state, analyzing the gap data, and compiling a gap report. 5. Gap analysis can also be used to assess the difference between rate-sensitive assets and liabilities. Hope this would help. Thanks for watching.